Good afternoon to our participants from Europe and a very good morning to those dialing in from North America. Welcome to the second Emerging Market Debt webinar of 2025 by J. Stern and Company. My name is Som Bhattacharya, and I'm delighted to be joined by both the PMs of the Emerging Market Debt Strategy, Jean-Yves Cheroux and Charles Chelinet. We have an interesting presentation for you today, and I will shortly be handing over the rein to the PMs. But I did want to spend just a minute on J. Stern and Company for those of you who perhaps don't know us from too well. J. Stern and Company is an independent asset manager based in London and backed by the Stern family, a historic European banking family that has long track record of investing in quality assets. While most of our investment professionals are based in London, we also have offices in Malta, Milan, Zurich, and New York. In total, we manage about $2.5 billion as of end of October across three main strategies: global equity, emerging market debt, and football financing, all with excellent track record. We rely on proprietary bottom-up credit research and analysts in our team. Last but not the least, one of the important differentiations for our firm remains that the Stern family co-invests up to 20% in all the strategies, thereby creating a powerful alignment of interest between clients and the Stern family and partners. If we move to the next slide, Elise, we can start our presentation on emerging market debt by reminding the participant the key outlines of our strategy. Firstly, the EM Debt Star strategy in J. Stern and Company is an emerging market corporate strategy. This means we don't have pure sovereign exposures in the portfolio. Secondly, this is a hard currency fund with US dollar as its base currency. This is an important point as emerging market local currency volatility can sometimes be as much as 3 times that of EM hard currency assets. In terms of objective, the strategy aims to generate strong risk-adjusted returns over the longer period. We achieve that through a highly active approach in portfolio construction with consistently more than 90% active share proportion. Lastly, the fund is an Article 8 UCITS fund with daily liquidity. If we move to the next page, we have 4 items on our agenda today. We would briefly cover reasons to consider the asset class, then performance, positioning, and the outlook. With that, I would invite the PMs to take you through the rest of the presentation. As ever, please feel free to submit any questions you may have. We would answer as many as we can in the webinar, and we can come back to you individually on the rest. To Jean-Yves and Charles.
Tom, thank you very much for the introduction. As you may all be familiar, at least for those who have followed our presentation over time, we tend to always start with the asset class, and the reason why we encourage people to at least have an allocation to the asset class. First and foremost, if we switch to the next slide, is the performance, and the fact that in a lot of cases, the performance is better than a lot of people assume. And as you will see with this chart on the left-hand side, as we all expect and know, over the last 25 years, more or less, US equities have been by far the best performer in US dollar with around 10% annual performance. But surprisingly, emerging market high yield corporate debt is the second best performer with in excess of 8% per annum, which is by far within the emerging market space, the best performer, as you can see here, both for equities and for sovereign debt. And again, this is, I'm sure a big surprise to a lot of people. On the right-hand side, again, you will see there that if over time the performance has been good, it hasn't been totally sheltered from accident from time to time and correlation to other asset classes. But as you will see, there is a limited number of years or downside years. Next slide explain The reason why some mentioned the fact that we feel we can achieve or provide investors with attractive risk-adjusted return, and one of the key features of the strategy and the asset class is the fact that it provides investors with low volatility. And as you can see here, we are looking at events of sudden rise in volatility. And as you can see on the left-hand side, the Lehman crisis. In the middle, you will see the COVID crisis. But more recently, in April this year, the surprise liberation day, so to speak, which obviously triggered high volatility in equity markets, and the S&P 500 top to bottom was actually down around 20%. Our strategy was down 1.5%. And we feel that not only this is obviously an excellent performance, but again, the argument being of diversification relative to other asset class is very strong in our view. Next, looking at the risk, and within the credit space, obviously, the first ratio that people would be looking at is the default rate. And we explained already before that over time, the default rate for emerging market corporate high yield is very much in line with the equivalent for US high yield. And that is over a long period of time, with the exception of 2 years, 2022 and 23, which essentially highlight one is the Ukraine crisis, and second, the issue with the property market in China, with both being large components of the index. But if adjusted for that, and you can see that on the right-hand side, 22 and 23, those default rates were bang in line with the US high yield. Now, looking at the beginning of the year, again, we are within the ballpark of the ratios versus the US high yield, and the expectation for next year are, again, very, very similar figures. Last but not least, next slide, is the fact that this asset class has changed tremendously over the last 15 years. And one of the main change essentially has been the incredible growth that the asset class has seen, 50% over that period of time. And now actually the size of this asset class is actually superior to the US high yield by a large margin. And again, these offer the portfolio manager, or provide the portfolio managers with the opportunity to have a larger pool of investment opportunities, more attractive, more countries, and therefore for active managers like us, the possibility to build better portfolio for our clients. Now I'll pass it over to Charles.
Thank you, Jean-Yves, and welcome again to everyone who's joined. I think let's just dive straight into the performance. And I think we're going to start by saying our simple, robust, repeatable investment process has helped us deliver the asymmetric return profile. This means we've captured more of the upside than the downside of the market. You can see in years like 2020, 23, and 24, we capture most, if not all, of the upside of the asset class. But maybe more importantly, given it's a fixed income strategy, we have in years like 21 and 22 performed significantly better. On average, since the inception of the strategy, we've captured 100% of the upside and 72% downside protection. 2022 is probably a good year to talk about, just to give an example of how our credit selection and duration management helped us drive alpha. Specifically, during that year, we avoided Russian corporates and the Chinese property blowout, which were two of the main pitfalls during the year. We also kept duration relatively short when interest rates were rising, which helped us with that alpha generation, as I've talked about. Now, if we just move on to the next page, and sticking with performance, we want to highlight a couple of things. We want to talk specifically about the three-year time period, time period where we generated an annualized return on a gross basis of 11% or 9.9% on a net basis. We want to talk about this period because this is effectively the period where we've got through the repricing of US interest rates in 22, and interest rates have been somewhat more stable during that period. Now, we talk about 11% gross return on an annualized basis. That's strong on both an absolute and relative terms, outperforming the comparator. We also like to talk about the high degree of visibility in that return, which has primarily come from the income generation. And you can see there on a 3-year annualized basis, we've generated 7.7% income, which is strong. And I think, again, when we talk about the visibility, an important point to make is if we rewind 3 years prior, we had a 11.5% yield to maturity on the strategy. and a 7.6% income yield. This income yield is obviously the companies in which we're investing paying their coupons, and it's a realized return, which can accrue or be distributed to our clients. Then, fast forward 3 years later, and the total returns we've generated are broadly in line with those yields, as I've just touched upon. Now, turning to risk as a measure of volatility, if we can go back, sorry, just go back to the previous slide. Still talking about those returns, one is obviously strong on an absolute and relative basis, but also we need to talk about how we've generated them in terms of volatility. And we managed to generate those returns with a very low volatility. You can see a 4.6% volatility over the last 3 years, which is very good compared to other risk assets. So this combination of strong returns and low volatility provide very strong risk-adjusted returns. Or put another way, we like to say we're generating equity-like returns, but with significantly lower volatility. Another point to make just on this slide is about the 3 years. And the reason why we talk about the 3-year period as well is we're coming up to the 3rd-year anniversary of our Luxembourg UCITS fund, which mirrors the strategy. This will be happening in February next year. So again, a very good and important milestone for us. Spending a bit more time just on the slide, we've talked about the longer term returns, but let's just talk maybe more near term. So you can see 2025 year to date, we've generated returns 5.3% gross, 4.2% net. This is obviously positive in total return terms. The income we've generated is bang in line with what we expected. However, you can see the capital appreciation has been slightly negative. This is largely due to one position we hold. It is important to emphasize that this is an idiosyncratic event, which we'll talk about in a second, rather than reflective of the overall portfolio, which has generally held up very well. So if we move on to the next slide, we'll talk about this idiosyncratic credit. There's a company called Braskem, which is in our portfolio. It's one of the largest petrochemical businesses in the world, headquartered in Brazil. The company, like others in the sector, have suffered from a prolonged downturn in the cycle, which has had some pressure put on its cash flows and on its balance sheet. In September, bonds sold off quite significantly when the company announced that they engaged advisors to look at the capital structure. The sell-off was exaggerated by low trading liquidity, and we're currently standing with bonds at relatively low cash prices. However, we still believe in the fundamentals of this business, and we believe there's significant room for recovery over time as the situation evolves. Why? The company is partly state-owned and has repeatedly been hailed as a strategic asset for the country in what is a very important sector for the country. We're likely to see a certain level of support coming through, which we are starting to hear about already. Also, we believe this is a cash flow and liquidity issue rather than a solvency issue, and the company has multiple drivers and levers to pull to help address the situation in the near term. Moving on, if we just go to the next slide, if we look again, talking about over the short period in terms of our performance, and for those of you who look at us on a relative basis, why we've kind of underperformed the comparator somewhat over this year. And the reality is, we have an underweight versus the comparator. We started the year with a duration of around 2.5 versus the comparator at 4.2. Why did we do this? Well, we believed that valuations, i.e. credit spreads, were at the tighter end of historical ranges, and we wanted to protect against any future widening. This compares, again, to the comparator, which has a 4.2-year duration, which is significantly longer. And what's happened this year, as we show in this chart, is you've seen US Treasury yields decline significantly. This has obviously helped the longer duration bonds, which obviously comprises more often than not the higher quality investment grade space to perform. And if we just look at this in terms of the contribution to the returns, our duration underweight has contributed to approximately 1.4% of the underperformance this year. If we then move on to the next page, I guess that leads us on quite nicely to how we're positioned today. So then if we go on to the next slide, please. You can see there, we've actually decided to maintain our duration around 2.5 years. We believe that, again, the reason for this is around valuations and credit spreads to protect against any potential widening there. We also believe that our positioning in the kind of double B and single Bs is where credit spreads offer the most value and are supported by some underlying strong credit fundamentals. It goes without saying, though, that credit selection will be key here going forward. And I think that's, critical in the way we manage the strategy, with a high conviction on 40 to 60 underlying names. From a sector standpoint, we remain relatively well diversified and have been adding to areas where which we believe are more defensive and non-cyclical given the overall macro backdrop. Again, characteristics of the portfolio important to point out as well. We've got a 7.5% income yield. We've got an 8.6% yield to maturity, with, again, that relatively short duration, which we've talked about. And again, I highlight these because, the yield is a critical factor in the level of returns that we think we can generate going forward, as we've demonstrated in the previous 3 years. Now, if we just move on and look at the portfolio from a geographic standpoint, like the sector level, we are well diversified from a geographic standpoint. You can see that no one country represents more than 15% of the total exposure. And often these companies are international businesses, which means they are far more diversified if you look at them based on where their revenues are generated rather than a single country of risk. Now, tariffs obviously are still a big question which we get asked about, and there are a few key points we'd like to draw your attention to. Firstly, we don't have any Chinese exposure. Secondly, when you look at line by line through our portfolio, less than 4% of our portfolio company revenues are directly exposed to the tariffs. This kind of brings us nicely on to the next slide, where we bring to light some of these stories. So we've seen headline duties, announced on countries like India, Brazil, Mexico, and South Africa, all countries where we have significant exposure. However, when you look at the portfolio from a bottom-up perspective, our companies continue to do very well. We have the recent benefit of third-quarter earnings with management teams which highlight the strong performance and constructive outlooks. There are a few examples here, but it tells the story of the overall portfolio, whether it be an agrochemical business in India, a protein business in Brazil, building materials groups in Mexico, or even a mining company in South Africa. All these businesses continue to perform, and we are very comfortable holding these. And then just maybe moving on, we continue, to see very attractive opportunities as well in the current environment, and have taken the decision to add new investments to the strategy as the years progressed. OCP is a good example. They are the second largest fertilizer company in the world and the leader in phosphates. We really like their scale, their market position, the high barriers to entry with exclusive access to the largest phosphate reserves in the world. They also have strong demand drivers supported by growing consumption and growing populations and increasing consumption. This is our first investment in Morocco, which has just been seen its credit rating upgraded to investment grade. OCP followed soon after and is now investment grade business. And it's a good example of how the sovereign can act as a country ceiling, even if the underlying corporates are very high quality. Hopefully, that kind of gives you some color of our positioning and what we're looking at the moment. With that, I'm going to pause. I'm going to pass you back to Jean-Yves, who's going to provide an update on how we see the world going forward.
Hello all, and welcome back. The outlook for this year, first, let's start focusing on the macro side. And obviously, the US, as it seems that the US is driving everything at the moment. From a macro standpoint, I'm sure you're all aware, GDP growth in the US has been better than expected, and tariff or no tariff inflation has been as well more sticky than people expected. However, the US labor market has been very resilient, and therefore there is a probability or possibility that, in fact, interest rate might stay longer or higher, for longer. From an emerging market perspective, growth, as you can see on the right-hand side, the chart there, is going to be, again, the driver of global growth for 2026. From a fixed income perspective, the debt metrics actually are quite positive, and fiscal discipline and monetary discipline has been implemented almost in all countries, and therefore we are starting 2026, or will be starting 2026, in a strong position. From the asset class standpoint, credit fundamentals are very robust. There's been, as we discussed before, limited amount of default, but as well, in a lot of cases, the debt maturity profile of a lot of the companies in the universe, but especially in our sample of companies, has been extremely high. The default, as I mentioned, is good. And if we look at valuation, and I'm sure there will be a lot of questions about that, spread have been tighter, and therefore there's a lot of, or there's certain possibility that it could be a widening, especially if the asset class was actually, or if there was increased volatility across asset classes. From a valuation standpoint, as we just mentioned, spread have been tighter. It is particularly true in the high grade segment, but as far as emerging market high yield is concerned, we are looking at the same point with a very important and attractive feature, which is the fact that the yield generated, or the income generated by the asset class, are very attractive. In an environment where I believe at the moment around 80% of the whole fixed income is yielding less than 5%, if you have the possibility to generate 8% or 7.5% in the case of our strategy, or 8% per annum, this is certainly a very, very attractive feature. Now, if you switch to next page, looking again at the outlook, I'm sure you're familiar with this slide. Which is a way for us to express, or at least give investors the possibility to work out their own scenario. It may look a little bit frightening or a little bit technical, but essentially what we are trying to show here is that depending on both the interest rate scenario or the spread scenario that people may have, you can see that in most cases, the returns that you should expect are actually positive, or will be positive. The case here is that we are currently, in that top right-hand side, the US Treasury yield for the 5 years are around 3.7%, and the index spread is around 190 bips. Now, if we decide that, for example, interest rates are going to rise to 4.25, and spread will remain at the level of 200 basis points, this strategy will still generate 7%. So again, the range of possibility here, depending on various scenarios, doesn't mean that there's not going to be volatility, but that over the duration of the portfolio, which is very short, as we discussed before, around 2.5 years, you will still generate positive return. And we believe that in an environment where obviously some asset classes have performed very, very well, and we feel that there could be a need for diversification, this is something which is attractive. Now, next page, we are trying to demonstrate this case with a mix of, at one hand, global equities, whether you choose it to be, 100%, and that your returns are going to be potentially in a return of, 10.5%, 10.67 here over a cycle, but with a volatility in a region of 14%. If you were to add 50% of, our strategy, emerging market corporate debt, but in hard currency, you will barely change the profile, the return profile, with around 9.7% per annum, but you will reduce the volatility substantially with only close to 9%. So we feel that, again, there is a strong argument for investors to add to this position, or at least start and benefit from the sort of returns. So next slide essentially is a summary, and taking back some of the points we discussed before. As Charles mentioned, our UCITS fund will have its 3rd year anniversary next year in February, and we believe, as we just mentioned all, that it is a very, very attractive opportunity.